The Aerospace Renaissance, a comprehensive guide to GE Aerospace. As of March 6, 2026, the name General Electric evokes a very different image than it did just 2 years ago. The sprawling, debt-laden industrial conglomerate of the past is gone. In its place stands GE Aerospace, ticker GE, a lean, pure-play aviation titan that has emerged as perhaps the highest-quality large-cap industrial stock in the world. Following the historic three-way split that concluded in 2024, spinning off GE Healthcare and GE Vernova Energy, GE Aerospace is now entirely focused on the flight deck of global commerce. For an investor today, GE isn't just a bet on planes, it is a bet on the world's most dominant engine manufacturer during a period of unprecedented aviation demand. This guide explores the company's $190 billion record backlog, its $1 billion investment in service infrastructure, and the specific financial tailwinds driving its 2026 valuation. 1. The business model: engines as an annuity. To understand GE Aerospace in 2026, you must understand that the company doesn't just sell engines, it sells time on wing. The company's business model is built on a razor and blade strategy, but on a massive multi-decade scale. I. Commercial Engines and Services, CES. This is the heart of the company. GE Aerospace and its joint venture partner, Safran, through CFM International, power 3/4 of the world's narrow-body aircraft. In 2026, the LEAP engine, which powers the Boeing 737 MAX and much of the Airbus A320neo family, is the company's primary revenue driver. The services moat. Once an engine is sold, it enters a 20 to 25-year service life. Every few years, that engine must undergo a shop visit for maintenance, repair, and overhaul, MRO. GE Aerospace controls the intellectual property and parts for these visits, creating a massive stream of high-margin recurring revenue. Pricing power. In early 2026, GE has demonstrated exceptional pricing power. As airlines face a shortage of new planes, they are flying older fleets longer, which requires more frequent and expensive MRO services, all of which flow through GE's shops. I-2. Defense and Propulsion Technologies, DPT. This segment serves as the sovereign shield. GE powers a vast array of military aircraft, from the F-18 Super Hornet to the UH-60 Black Hawk. In 2026, this segment is seeing a surge in orders as global defense budgets are modernized. Next-gen tech. GE is currently leading the development of adaptive cycle engines and hybrid electric propulsion, positioning itself to win the contracts for the sixth-generation fighter jets that will define air superiority in the 2030s. 2. The 2026 catalyst, the $190 billion backlog. The single most important number for a GE investor in March 2026 is $190 billion. This is the total value of orders on the books that GE has yet to fulfill. Why the backlog is different in 2026. In previous years, a backlog was just a wait list. In 2026, it represents visibility through the end of the decade. The equipment surge. In the fourth quarter of 2025, reported in January 2026, GE Aerospace saw a staggering 74% surge in total orders. Equipment orders specifically more than doubled, reflecting the aggressive procurement plans of global airlines like Air India, United, and Emirates. The service support. Within that $190 billion, the majority is tied to high-margin service contracts. This means that even if the global economy slows down and new plane orders cool off, the installed base of 50,000 commercial engines still needs to be serviced, providing a solid floor for the stock price. 3. The service engine, investing $1 billion in the future. As of early 2026, GE Aerospace has embarked on a massive multi-year $1 billion global investment in its MRO, maintenance, repair, and overhaul, network. The bottleneck battle. Throughout 2025, the aviation industry's biggest problem wasn't a lack of demand, it was a lack of capacity. Engines were spending too much time in shops due to labor and parts shortages. Capacity expansion. This $1 billion investment is aimed at adding new test cells and shop capacity in locations ranging from Brazil and Scotland to Singapore and Ohio. Turnaround times. By reducing the time an engine spends in the shop by even 5%, GE can significantly increase its annual throughput, directly boosting its 2026 and 2027 free cash flow. 4. Financial health. EPS, dividends, and buybacks. For an investor, GE's 2026 financials reflect a company that has moved from survival mode to compounding mode. Key data points. As of March 6, 2026. Stock price. Shares are currently trading near $345.74, up from roughly $160 just a year ago. 2026 guidance. Management has projected an adjusted annual per share of $7.10 to $7.40 for the full year 2026. Operating profit. Company expects operating profits between $9.85 and $10.25 this year, a double-digit increase over 2025. Capital return. GE Aerospace has become a shareholder-friendly machine. On February 6, 2026, the board declared a quarterly dividend of 47 cents per share, payable in April. Aggressive buybacks. In late 2025, the company accelerated its share repurchase program, aiming to reduce its share count by a modest single-digit percentage in 2026, which further boosts the EPS for remaining holders. 5. Sector dynamics. The Airbus and Boeing factor. GE Aerospace operates in a duopoly alongside RTX's Pratt & Whitney that serves another duopoly, Airbus and Boeing. In 2026, this dynamic is uniquely favorable for GE. The Boeing tailwinds. While Boeing continues to navigate production and quality challenges in 2026, this actually creates a paradoxical benefit for GE Aerospace. Because Boeing and Airbus are struggling to deliver new planes fast enough, airlines are forced to keep their existing GE-powered planes in the air longer. This older fleet requires more frequent and deeper maintenance, the highest margin work GE does. The Pratt & Whitney edge. Competitor Pratt & Whitney is still working through the fallout of its GTF, geared turbofan, engine durability issues. While Pratt is making progress in early 2026, GE's LEAP engine is perceived by many airlines as the more reliable, workhorse choice for narrow-body fleets, allowing GE to capture additional market share in the lucrative narrow-body segment. 6. The critical risks. What could derail the investment? Even a gold standard stock like GE in 2026 has specific risks that you must understand. The priced for perfection problem. As of March 2026, GE has seen a historic 70-plus run in the last year. It is currently trading at a forward PE ratio of over 45x. This is a significant premium compared to the broader market and even other aerospace peers. At this valuation, any minor disappointment in quarterly results could lead to a sharp valuation reset. Supply chain fragility. GE Aerospace is only as fast as its slowest supplier. In 2026, global shortages of aerospace-grade titanium and specialized castings continue to be a drag on production. If GE cannot accelerate engine deliveries to match its $190 billion backlog, it may face performance penalties from aircraft manufacturers. Geopolitical and energy risks. Aerospace is highly sensitive to the price of oil. In early 2026, geopolitical tensions in the Middle East have pushed oil prices towards $75 to $80 per barrel. While newer GE engines, like the LEAP, are fuel efficient, a sustained spike in oil prices could hurt the profitability of GE's airline customers, leading them to defer major engine overhauls. The 2030 service cliff. Some bears argue that as more airlines transition to the newer LEAP engines, the massive profit pool from the older CFM56 engines will eventually begin to dry up. Management must perfectly time the ramp-up of LEAP service revenue to offset the decline of the older generation. 7. Strategy. How to position GE today. In March 2026, the analyst consensus on GE is a strong buy, with a median 12-month price target of $391.50, representing a roughly 13% upside from current levels. The core industrial approach. The buy on dips candidate. Because the stock has run so far, many institutional investors view the recent January pullback to $330 range as a primary entry point. The IRA/401k anchor. Due to its 1.6% yield and its status